Hey guys, Bob Iaccino from the Stock Think Tank, co-portfolio manager, of course, along with Mike Arnold. And this is going to be a short weekly update. It's March 16th right now. And the reason it's going to be short is because there's not much to talk about in terms of the portfolio. The markets are basically in the same sort of stance that they were last week. They're not at the same levels. They're a little higher. Right now, I marked the SPY on the month, middle of March, up a little over 4%. And we're not up that much. We've had 3 outperforming months in a row against the SPY, and we're likely to underperform. Now, if you remember my whole rant about what a hedge fund really is, underperformance doesn't necessarily mean that you make more every single month than the index or than your benchmark, which we count as the S&P measured by the SPY, which is the investable ETF. We look at it on a cumulative basis, and I'm really proud of our cumulative return over the last 12 months. As per the end of February, over 97% in our model portfolio. Almost 100% return without using GameStop or Tesla or Plantier or Beyond Meat or any of the other high-flying, hot momentum names that you watch go up every day and wonder, why aren't we doing those? Well, we don't do those because, as you've seen from some of the down moves in those stocks, it can be just as painful. What we do instead, or I should say what we did last year, because I can't guarantee we're going to do it again, is we return in a 12-month period almost 100%. Again, last year. Can't promise we'll do it again. But we return almost 100% on your money last year without being in those crazy stocks, without doing it. So it's kind of a neat thing what our process does, because you look at, for example, what we have in the portfolio right now. We've got Canadian Pacific and Lockheed Martin. Couldn't get more vanilla. But as of the end of February, we were up 14%. S&P, not even close to that. Not even close. S&P was up a little bit less than 3% year to date at the end of February. And it's just all vanilla, solid companies that we enter at the right time and we exit at the right time. So right now, Canadian Pacific, Lockheed Martin, today, March 16th, we entered a stock that you probably never even heard of. Henry Schein Incorporated. They're a dental supply company. They're actually on their all-time highs. They've actually traded since the late 90s. Since the late 90s. Probably never even heard of them. I know I never heard of them until we started looking at the chart and looking at the stock because it came up on one of our scans. Now, this particular stock stands a chance to break out. Why? Because dental equipment and dental supplies can break out with a reopening trade because people are going to start being able to go to the dentist again. While you had a replacement for your restaurants, you had food delivery services. For your grocery store, you had Instacart. For your department store shopping, you had Amazon and Walmart. How could you go to the dentist during the lockdowns? You couldn't. You could not. So when we reopen, what's the first thing a lot of people are going to have to do? Things they couldn't do. One of those things may be the dentist. Now, that's not why we bought it. We bought it because it fit our process and the chart fit our price action analysis. But think about the story behind that. This stock could actually do really well really quickly for us, or it could stop out. We don't care either way because we still follow our process. So that particular stock is an interesting way of showing how we come up with things that other people don't without going into the risky stuff. So we've got an FOMC meeting tomorrow, actually, and that's what the whole market is kind of poised on. And it wouldn't shock me if we had a sell-off in toward the end of the month. Wouldn't shock me at all, because there has been some analysis lately that the Fed might be ready to surprise the market, not this meeting, but maybe the next couple of meetings or the next couple of speeches, and maybe do things a little quicker than the market expects. I think we're going to see inflation. I do. You read it in my last update. So that's the update. Henry Schein and Company, ticker is HSIC, I think. Henry Schein Incorporated. Yeah, HSIC. That's the newest addition to the portfolio. Portfolio is still underweight, and it still looks to me like the buy and holds are weak. So let's see if I'm right. I'll talk to you guys in next week's update. Thanks for watching.